good morning or good early afternoon, everyone. My name is Andrea Mao. I'm a partner at Eide Bailey in the accounting methods practice, and Michelle Korglanian is a manager on our team here. And today we're going to talk about some of the hot topics and current developments in the accounting method space. There are a few different big issues going on, I guess, that I'm sure you have heard quite a bit about, regarding the CARES Act, the Tax Cuts and Jobs Act from 2017, and then just some other recent IRS and Treasury guidance related to accounting method issues. And what we're going to do today is try to talk through some of what we're seeing in these areas. So for example, in the CARES Act, we have the QIP correction, we've got people claiming misdepreciation, we've got some people looking at the NOL carryback rules, 163J elections. We're still getting questions on small taxpayer accounting methods, and then the new GAAP revenue recognition standards and the new RevRec rules in the TCJA. And then the UNICAP regulations under 263 Cap A for the negative additional costs. Disaster losses is an area people are starting to take a look at in light of the COVID activities that are going on right now. And then if we have time at the end, we'll wrap up with a brief discussion on the new GAAP and tax leasing considerations we should be looking at. So our first topic is we're going to start by going through some of the accounting method related issues in the CARES Act. And with that, I'll turn it over to Michelle.
Thank you, Andrea, and welcome everyone. I'm so glad you were able to join us today. And I guess with respect to these particular areas, the first one we're going to jump right into is the technical correction with respect to depreciation for qualified improvement property. And the definition you see on the next slide, that qualified improvement property, or QIP, there's some important words that we need to focus on here. It's something that's interior, it's non-structural, it's a non-residential building, it's made by the taxpayer, and it's placed in service after the building was placed in service. All of those words are important to note in figuring out what qualifies. And a common misconception that we're seeing is situations where a taxpayer thinks this rule or this change in the law only applies to a real estate business. And that's not true. It can apply to any taxpayer that owns or rents real estate if you meet the above definition with respect to a particular fixed asset. So for example, a manufacturer who makes improvements to their production facility might also have some qualifying improvement property. Now, on the next slide, we'll see that this really is a drafting error that was in the Tax Cuts and Jobs Act of 2017, and qualified improvement property that was placed in service after December 31st, 2017 was treated as depreciable over a 39-year life without bonus depreciation. The CARES Act has made the necessary technical correction, and QIP should now properly be depreciated over a 15-year life. And if it meets the necessary requirements, it may also be eligible for 100% bonus depreciation. This change is retroactive back to January 1st, 2018. And it's extremely important to note that as a result of this legislation, the IRS now views the use of 39-year life for QIP as an improper method of accounting. So if you have any fixed assets that meet this definition, you must change the recovery period. If you do not, you could lose some of the tax deductions you are otherwise entitled to.
I think that's been a surprise to a lot of our clients. I mean, most people think that, what does the IRS care if I don't depreciate things as fast as I could? It's only a detriment to me. But in reality, as you alluded to, there is a potential basis loss if we don't claim all the depreciation that we are eligible for. And the IRS, when Treasury or Congress fixed this, the Treasury decided they don't have an option but to force everybody who had 39-year property into changing it to 15. The result is that we've had some taxpayers making this change for seemingly very small amounts of additional depreciation.
Mm-hmm. And the good news is that there actually are several different options on how you make that correction. Some taxpayers may want to amend the 2018 or 2019 tax returns to claim the proper depreciation on these QIP assets. And for many taxpayers, they would have until possibly up to October 15th, 2021 to file the amended tax returns. There's some limitations and special rules. Partnerships in particular are a bit more complicated. Not all partnerships are able to file an amended Form 1065, but often where they can, they would need to file by September 30th, 2020, possibly, if they want to go that route. But a lot of taxpayers don't like filing amended returns. It's a lot of extra work. It can be complicated for a variety of reasons, possibly need to amend state tax returns. If you're a flow-through entity, you've got individual returns. So as an alternative, instead of amending returns, taxpayers do have the option to file a Form 3115 change in tax accounting method. And this is often significantly easier to implement. Either way, you're getting the cumulative impact. You're going to get the benefit of all the deductions that you would have been required to. With the Form 3115, we make the change as of the beginning of the year of change to take into account whatever the cumulative amount of deductions you would have been entitled to through that time, and then you go forward using the new method of accounting. There's some simplified filing rules here, but it does still require a Form 3115 to be filed with a tax return. In addition to the depreciation for the QIP, we also have some other changes with respect to depreciation that taxpayers may want to consider. We have the first one relates to bonus depreciation elections, and some taxpayers particularly may have elected out of bonus for some reason in their originally filed 2018 or 2019 tax return. They may now want to revoke that election with respect to one or more asset classes, or alternatively, maybe they took the bonus depreciation but decide now they don't want to because of some of the other changes in tax laws and situations that have arisen because of COVID. And so taxpayers do have some options here to either make or revoke elections, again, with amended returns or with a Form 3115 for bonus depreciation. And similarly, with respect to the use of the alternative depreciation system, or ADS, where you typically are depreciating an asset over a longer life, you now can either make or revoke an ADS election as well. However, one thing to note here is if you do want to revoke an ADS election, often that withdrawal can only be made with an amended return.
It's interesting that we get a lot of confusion from people regarding these bonus elections. And the important thing to remember is that the way the bonus rules apply are if you place in service a qualifying asset, you have to take bonus. Your only way not to take bonus is to file an election, as Michelle was just talking about. So taxpayers often think, oh, if I have to make it in order to take bonus, and it's actually the opposite. If you don't want bonus, you need to make sure you're making an election. Otherwise, the IRS is going to force you to take bonus depreciation on those eligible assets.
Okay. And as you can see here, there's a variety of situations that may impact your decision on whether to claim bonus or to opt out of bonus. But the thing to note here is really that the original decision made in your 2018 or 2019 tax return might not necessarily have been the right decision now due to various changes in the law. And this takes us to the first polling question.
Which is, which option are you planning to use to implement the QIP depreciation correction? An amended return, a 3115, or none of the above because you don't have any assets that you need to change?
Great. Polling question 1 should be open. You should see a box in the middle of your screen that allows you to click and submit your vote.
I think what we've found among our clients thus far is that most people are opting for the 3115 route rather than the amended return route. As Michelle said earlier, the amended returns can generate a lot of additional work and confusion and complexity. And it's just easier to do this with a Form 3115. But we still have seen some taxpayers amend those returns. Oh, and actually 72% of people don't have assets to change. Very interesting.
Okay. And the next topic we're going to go into here also is from the CARES Act. We're just going to touch a little bit on the net operating loss rules. Keep in mind that in the past, carryback in recent years has not been permitted, but now with the law change in March, NOLs that were generated in 2018, 2019, or 2020 can now be carried back 5 years. And in addition, at least for now, losses from pass-through entities can fully offset income in those years. The excess business loss limitation from the Tax Cuts and Jobs Act has been repealed. But I did say, at least for now, there are some proposals in Congress to further modify the rules again for non-corporate taxpayers. Now, some situations with NOLs are more complex than others. We've already received some additional guidance from the IRS on NOL carrybacks, and there's probably more to come. But the key thing to keep in mind is actually that NOL carryback could result in some permanent tax savings. On the next slide, we'll see that we had different tax rates back in years prior to 2018. We had the 35% rate for corporations that's now been reduced to 21%. So if you do have an NOL that you could carry back from 2018 to 2013 at a 35% tax rate, you're going to get some cash savings, some permanent cash savings out of that, whether instead of if you had carried it forward at a 21% rate. And as a result of that tax rate differential, whether it be on the corporate side or even on the individual side, where in the past they might have been taxed as high as 39.6% for individuals. If you have a loss or can increase an NOL for carryback, you might be able to do that and get that additional savings. One of the ways could be things like the depreciation rules we were just talking about, but also tax accounting method changes. And we've got a list here of some of the common automatic tax method changes that can help you to either create or increase an NOL available for carryback. But one of the things you really need to be cautious here with respect to NOLs is there are traps for the unwary. Modeling is very important before any final decision is made. There are so many areas of the code that are interconnected as far as computations that we really do have to be careful, especially in the international area. Some of those newer tax laws really are complicated, so you do need to be careful and talk to your advisors before making final decisions on implementing a particular strategy with respect to NOLs.
And the other thing here is, similar to what we talked about in the bonus depreciation setting, there are certain assumptions as to what taxpayers are required to do and then what elections that they can make not to. So for example, in the NOL space, you are required to carry a loss back unless you affirmatively elect to forego the carryback and roll it forward. So if you don't want to use your loss in the past, when you filed your 2018 return, you didn't even have this option. So you wouldn't have included an election, you wouldn't have even considered it. Well, now you are obligated to carry that loss back 5 years unless you make an election going forward. So those are things that you have to be mindful of, is there are certain actions you need to take if there are, depending on which solutions you are looking for. And also in the pass-through loss limit, as Michelle mentioned, the 461L excess business loss rules, those also do not appear to be optional, meaning that if I limited a loss on my 2018 or 2019 return under those rules, I have no choice but to go back and amend that return. The IRS has not provided us with any other procedures or any other shortcuts to do that. We have no choice but to go back and amend those returns, which is not desirable for a number of taxpayers. So we're hopeful we'll get something from the IRS that might give us an out on that. But right now we don't have anything, and I'm not aware of anything in particular the IRS is working on that would relieve that obligation. So I mean, just more additional traps, I guess. The NOL carryback is great and it is generating a benefit for a lot of people, but there are a lot of things that need to be considered and actions that are needed, that you need to take in order to make sure you get the result that you are looking for. The third item that impacted some of our accounting method issues that was included in the CARES Act is the interest expense deduction limits under 163J. The Tax Cuts and Jobs Act introduced a new limitation on the deductibility of business interest to the sum of your interest income and 30% of your adjusted taxable income starting in the 2018 tax year. The CARES Act, what they did is they increased that deductible interest threshold from 30% to 50%. For our taxpayers other than partnerships, this adjustment applies for both 2019 and 2020. Partnerships, it only applies in 2020, but there are some rules that allow us to accelerate the use of those interest expense deductions. And we can also, for 2021, for our next year, a year from now, when we're doing our 2020 returns, we also have the ability to make some elections around which adjusted taxable income number we are using. And so we have seen that there are some taxpayers in 2018 or 19 that did run into a limit, and that the movement of this from 30% to 50% did generate an additional deduction for them, generated an additional NOL, things like that. These are all, you know, interconnected and lead to tax potential avenues to tax savings. The other thing that the IRS is allowing us to do is to modify some elections that we may have made related to the interest expense rules. Specifically, taxpayers in farming and real estate businesses did and do have an opportunity to elect out of the interest expense limits. What that means is that they can fully deduct their interest expense. They don't need to worry about how much adjusted taxable income they have. They can fully deduct those amounts, but the trade-off is certain classes of assets need to be depreciated using the ADS, or the alternative depreciation system. This generally slows down your depreciation and makes you ineligible for bonus depreciation on any categories that would otherwise be eligible for bonus. The rules prior to the CARES Act were that this type of an election was required to be made with the tax return and was irrevocable after that. The CARES Act, as Michelle alluded to earlier, made a lot of modifications both to 163J, the QIP technical corrections. Now all of a sudden, maybe I want to change my mind about that election. I want to make an election where I didn't before, or I want to revoke an election that I did make. We are now allowed to modify those. But we can only do that through filing an amended return. So if we made an election out of 163J on either the 18 or 19 return, we now don't want to make that election anymore because the 50% threshold covers all of our interest, or because we now want to take bonus on QIP, we want to change that election, we can. This is a limited window of time during which we can make this adjustment, but it will require an amended return. And we are going to need to make sure that we're taking into account all other adjustments to taxable income, because when we revoke an election like this, we'll be increasing our interest expense, but then we also need to consider what impact that is going to have on our depreciation expense, and effectively, again, rerun the return and see where else we will have changes as a result of the election modification. With that, we are at our second polling question. Which CARES Act provision impacted your business the most? The QIP correction, the NOL carryback, the pass-through loss limits, or interest expense? I think from our perspective, at least, most people are spending their time largely on the QIP issues and the NOL carryback. There are some taxpayers who got hurt by the pass-through loss limit rules, the excess business loss limitations, and obviously they are very concerned about getting those recovered. But by and large, I think the larger issues we've seen interest in are the QIP correction and the NOL carryback. And one final note on the interest expense limits under 163J, the IRS has a batch of final regulations and revised proposed regulations. Those have departed Treasury or departed OIRA, the administration review of those, and will be likely released any day. So hold your breath. The rumor is that they will be taxpayer favorable, but obviously we need to see the details on that first, but something to keep in mind. And now I think we are going to turn to the other accounting method provisions in the Tax Cuts and Jobs Act, starting with the small taxpayer rules.
Okay, thank you, Andrea. And these are a little bit older issues since they are from the Tax Cuts and Jobs Act from December of 2017. But we are still seeing a lot of interest, a lot of activity in this area. And they can provide, some of these provisions can provide some nice benefits to applicable taxpayers. There is a specific definition of what is a small business taxpayer, and essentially it is looking at what are your average annual gross receipts over the past 3 years. It originally was defined as 25 million. It's been indexed for inflation and is now up to 26 million. There are some exceptions on who may be considered a small business taxpayer as well, but if you qualify into that definition, you may be able to avail yourself of the use of the cash method of accounting instead of accrual, and that can be a very nice benefit, especially if you have a significant amount of accounts receivable where under the cash method, you would be able to defer the recognition of that income until the later year when it's received. There also are some special rules for small business taxpayers with respect to inventories. And for certain small manufacturers, they can receive some benefits about how they're treating these items of inventory, especially if they have significant work in process or finished goods. And this can apply to both producers and resellers as well when we're looking at the from the UNICAP rules. All of these method changes, though, another thing to keep in mind is it's not just kind of a one and done. You need to monitor your facts, what your situation is. If you originally do meet that definition of small business taxpayer and you avail yourself of one or more of these methods, but your facts change over time, your average annual gross receipts are now over whatever the current limit is, you may have to change back to accrual, for example, from cash, or deal with the inventory rules or the UNICAP rules as well. So it's something that you just need to keep in mind, that once you do avail yourself of these rules, it's not necessarily permanently forever into the future. Now, you need to be a little bit cautious because we are awaiting guidance from the IRS on some of the problems and issues in this area as well. There's a lot of guidance that the IRS has been working on relating to the Tax Cuts and Jobs Act, much of which is not yet out. And much of it has been delayed a little bit because of some of the situations going on with COVID. But several things to keep in mind in the meantime is that average annual gross receipts test. It's not typically looking at the gross receipts of just a single taxpayer. If there are other taxpayers that are under common control, we need to be looking at all of those taxpayers, aggregating their gross receipts for purposes of performing this test. And typically, we're going to run into this situation often with flow-through clients, throw-through entities. where there are 5 or fewer individuals who own a significant portion of each of those businesses, you need to combine them together and perform that gross receipts test. Even when we're dealing with C Corps, there can be brother-sister testing entities that we need to include in a test as well. Tax shelters are not eligible for these simplified rules for small business taxpayers. And I guess, Andrea, I'm not sure, have you heard anything lately about the timing on when we might get some guidance further from the IRS in the small business taxpayer area?
Not on the specific guidance project that is related to this, to these specific provisions. Interestingly, some of the comments I have seen in the last few days indicate that the small taxpayer definition for purposes of these tests is the same as the small taxpayer definition for purposes of being exempt from 163J. And there is a rumor that the 163J regulations that are nearing release have some language in them that will impact the application of some of these small taxpayer tests, specifically the tax shelter rules, perhaps some of the aggregation rules, what gross receipts need to be included. So it's possible we'll be seeing something, but in that, the other thing to be cautious of in that setting, even though these are all technically referencing the same 448 definition, we could end up in a situation where we have different sets of rules for different provisions. So just because there's something in the 163J regs doesn't necessarily mean that's going to resolve our issues for all of these items as well.
Okay, and with that, I think we're ready to go into the next topic, Andrea.
Perfect. Revenue recognition. So there's 3 issues that we're dealing with this year in the revenue recognition space. The first is the ASC 606 financial reporting standards. Those were effective for non-public clients for the 2019 reporting period, meaning that most of our clients, our firm's clients, went through the implementation process during 2019. Then on top of that, we have some changes to the tax rules that were enacted as part of the Tax Cuts and Jobs Act. 451B is a book tax conformity provision that can interact with the application of the new ASC 606 standards, and in some cases in a highly unfavorable manner for tax purposes. And 451C, which codified some existing rules regarding deferred revenue or advance payments and the ability of taxpayers to defer those past the year of collection. So when someone calls with a revenue recognition question, unfortunately, we have to step through all 3 of these tests to figure out what do we need to do for your 2019 return and how do we manage this going forward. The main issue and the main question I get on ASC 606 is, okay, my audit team told me I have to make a change to my revenue recognition and they've computed an adjustment to my financial statements. What do I do for tax purposes? Well, to figure that out, our first question is always, well, is that a permissible method for tax? Aside from the 451B and C provisions we're going to talk about in a minute, there really has been no change to the tax rules. For tax purposes, an accrual basis taxpayer is applying the all events test. All events have occurred to fix my right to receive the income, and I can determine the amount with reasonable accuracy. Those are my rules, not the 5-step process that ASC 606 is doing. Those are my rules. So what is my answer? Is my answer the same as the book answer? If yes, then I may also have a tax accounting method change to make, because similar to GAAP financials, when I'm changing an underlying methodology or method of when this revenue is being reported, I have to file a Form 3115 and alert the IRS to this fact as well. The good news is it's an automatic change, but nonetheless, we do need to go through the exercise of preparing the 3115. And what happens if it's not permissible? We are seeing some clients where their new ASC 606 method is not permissible for tax purposes. What that means is that we have a new Schedule M book to tax adjustment we need to start tracking. We cannot follow them. So in some cases, they are going to stop tracking some of this data that we are going to need for our adjustment. So working with the audit team and with the client's financial reporting folks to make sure that we understand what's being done on their side and how we go about undoing that for tax purposes. 451B, the way to remember this is B for bad. This is a highly unfavorable provision for tax purposes. And what it does is it adds an additional step to the all events test. So as I said before, your all events test is I have a fixed right to receive the income. I can determine my amount with reasonable accuracy. That was my test before. But if I'm subject to 451B, I have a third prong in that test. And that third prong tells me I cannot recognize the revenue later for financial reporting purposes, for tax purposes, than I am for financial reporting purposes. So in other words, if I'm going to accelerate the revenue and get the benefit of that on my financial statements, the IRS also is going to be able to tax that revenue in that same period. This is sometimes referred to as the AFS inclusion rule. In other words, it's a one-way book tax conformity. I can be forced to accelerate my taxable income to match book, but I do not have a right to defer my tax income just because I'm doing so for book purposes. So effectively, like I said, this is a one-way street, all in favor of the IRS. So what we've been, a lot of our clients, since this is unfavorable, we've been focusing on, okay, who's actually subject to these rules and what about their income is subject. So the good news is that this 451B, of the three provisions we're going to talk about, this impacts the smallest or narrowest group of clients. It applies only to taxpayers that have an audited financial statement. This does need to be an audit. A review would not throw you into this analysis. But the second group of taxpayers are those who are required to file financial statements with state or regulatory bodies. So unfortunately, this is captured in a number of our banking clients, even though they don't have an audit, because of their obligation to file with the state, with the FDIC, with the Comptroller of Currency, whoever it is, that is going to throw them into being subject to 451B. The second limitation is on what type of income is actually impacted here. This only applies to income that is subject to 451. There are a number of special rules in the tax accounting space for different types of arrangements. So for example, the long-term contract rules for construction and manufacturing activities. We have installment sale rules. There are special rules for rental accruals under 467. If our income is governed by one of those special rules, then we don't need to worry about 451B and worry about accelerating that income for tax purposes. The 451C rules, these are rules regarding advance payments. And so a common question I get is, well, what is an advance payment? An advance payment is a situation where I've collected cash from a customer for goods or services that I'm going to be providing sometime in the future. So they've prepaid for advertising services that I'm going to provide next year. They've prepaid for certain goods that I'm going to be providing to them next year. Software licenses is also a common scenario where we see this. Typically, you pay up front for the term of the license. And gift cards. Anytime you're buying a gift card, you're basically creating an obligation for that seller to satisfy goods and services in the future, but you've already given them all the cash they're going to get from that transaction, they have already received from you. So taxpayers that have any of those situations likely are subject to the advance payment rules. Typically, advance payments are reflected on the financial statements as a liability. Unearned revenue, deferred revenue, customer deposit, those are some of the more common account titles that we see, reflecting the fact that our client has collected cash but has not performed any of the required goods or services yet. And it surprises a lot of people to find out that this is actually an area of significant book tax nonconformity. We like to think, for an accrual basis taxpayer, I don't have to recognize income until I've performed my obligations under the contract. That is not the IRS's view. The IRS's view is that once you've collected cash, you can go ahead and pay your tax. Even if you haven't incurred any of the costs, you haven't performed any of the services, you still need to recognize that revenue for tax purposes on the date of receipt. So the basic general rule is that any of that cash that I've collected and I'm deferring for book purposes, I have to accelerate immediately for tax purposes. What 451C does is it gives us a 1 year, grace period on paying tax on that. This is, those of you who are familiar with Revenue Procedure 2004-34, this is effectively the same rules we had there. And what that tells us is that I will have to recognize that cash in the year of receipt to the extent that it's either picked up in my financial statements or I have earned it through performance in that year, but then everything else comes in the next year. So all the cash I collect in 2019, I have to recognize by the end of 2020. Book, on the other hand, is likely to spread that out until the end of the contract term, until all obligations have been satisfied. So they will have that liability on the balance sheet for quite some time. And this is where we get our unfavorable book tax difference, because we're going to pull that into income and they are going to continue to defer it. Another provision that was specifically impacted by 451C were the sale of good rules under 451-5. Some of you may have been using those. That allowed taxpayers to defer advance payments for 2 years past the year of receipt, but only for the sale of goods. And if you were using that method, you likely had a statement attached to your return that indicated advance payments collected to date, recognized, etc. If you have that, you were using this method and you have that attached to a prior year return, you have to file a Form 3115, because the IRS does not view that, at least currently, as a permissible method of accounting for advance payments. So, third polling question: which revenue recognition change will impact your business the most? ASC 606, 451B, or 451C?
All right, that poll is open.
And interestingly, I think probably the area where we have seen the most changes is in 451C, and that is probably the area that changed the least. The treatment of advance payments really wasn't changed by the codification of 2004-34. So I think there have been some surprises among some clients and tax staff that we can't just follow book for deferred revenue. And so we've probably seen the most changes in that space. And this isn't surprising. And ASC 606, depending on certain industries, had more changes than others. You know, a lot of the people in the franchising industry, I think, saw more significant changes than some others. So that has been largely, yeah, industry by industry, but I would agree 451B by far seems to be the least significant of the three for our client base. And then I think we are going to move on to some of the other hot topics and issues that have occurred, and Michelle is going to talk about the 263A regs.
Okay, thank you, Andrea. Back in November of 2018, some final regulations were issued with respect to Section 263 Cap A, or the UNICAP rules. And they didn't get a lot of interest or involvement by taxpayers right up front, because they were issued, I think, so close to the end of 2018. But with 2019 tax returns and 2020, taxpayers are really starting to dig into this area and try and better understand these final regulations and how they apply to their situation. Now, they're commonly referred to as the negative additional 263 Cap A regs, and they do address concerns in that area, but the regulation project really grew and they address so much more than that. So let's talk UNICAP. You know, UNICAP really is all about being its own set of cost accounting rules for tax purposes. And I know cost accounting is not everyone's favorite subject. The biggest problem we have here, though, is that the way the UNICAP rules were built is they were not easy to apply generally across every type of business, every type of fact pattern, every type of book cost accounting system and computer system. And it really is complex from the standpoint of how do I get myself from my situation for book purposes to what I'm supposed to do for tax purposes. And to get there, you do need to understand the UNICAP rules and what this special set of cost accounting really wants you to capitalize. But you also need to understand what is going on within the business operations of a company. Are they involved in just manufacturing? Maybe they've changed how they're doing manufacturing and they have some contract manufacturing or tolling arrangements. Maybe they have a little bit of resale activity where they just purchase goods and resell them without doing any further production to take and round out their product line. Maybe they've always been just a reseller but have started to get involved in some other operations. Maybe they've gotten spread out over different states and they have offices now, administrative offices one place, production activities there, but they also have production activity in a second area of the country or warehouses. all of those types of operational changes are important to keep up with. And similarly on the book accounting side, we need to know what costs are being capitalized for book and how they're being capitalized. If there are changes being made within that internal book cost accounting structure during the year, all of that is important to understand before we can figure out what we need to do for tax purposes for UNICAP. Now, as I said earlier, they often are commonly referred to as the negative additional 263 Cap A cost. And that's because of a negative cost situation or negative adjustments that really brought this issue to the IRS's attention. Bonus depreciation. It's great. We all love it. The first year you place an asset in service, you get that large tax deduction. But in year 2 on a production asset, all of a sudden things have flipped. Your tax depreciation, depending upon what year and what bonus rules applied, maybe you still have some tax depreciation in year 2 and on, but if it was 100% bonus, there's no tax depreciation when book is still using maybe a straight line method over 10 years or something. Book depreciation is greater than tax. Book depreciation is in those book costs that are capitalized to the inventory for those production assets. And taxpayers took the easy way out. They didn't want to try and recompute their book inventory without the book depreciation and using the tax depreciation. So they put it in the UNICAP calculation as a negative additional 263 Cap A cost. The IRS didn't like it. They said, you're not taking out exactly what was capitalized for book and replacing it with the proper tax depreciation. That simplified methodology didn't quite get you to the exact same place you would have otherwise been in. And there's other situations as well. Another common one is with respect to the treatment of pick and pack costs that might have been capitalized for book that aren't required to be capitalized for tax purposes. Maybe the production, the manufacturer has a forklift operator and he's responsible for goods as they are, raw materials as they're being received. He takes the forklift, takes the items off the truck, puts them into the raw material storage area. He moves them around for raw material storage onto the production line, off the production line to storage, and then later when we have a sale, also takes the goods off the final goods storage area and gets them over to the shipping department. Some of those costs are inventoriable for tax purposes, but that pick and pack portion, when they're filling a sales order, it's not capitalizable for tax. And for book purposes, a company might not have wanted to deal with separating the costs associated with that type of activity down into all those different steps, and they just capitalize all of his cost. Taxpayers might have tried to, again, treat a portion of that was qualified pick and pack as a negative additional 263 Cap A. We also see it often with Section 174 expenditures that are capitalized for book purposes but not required to be capitalized for tax. And as I said earlier, though, these regulations really went so much further than just treating those negative costs. They added a lot of new definitions. They changed what is the definition of a Section 471 cost. They've added some new optional simplified rules and safe harbors relating to standard cost variances and burden rate variances. And these rules are very complex. They can be confusing, and not all options are available to all taxpayers. For example, ironically, one of the alternative methods here that is intended to simplify the computations for UNICAP requires a taxpayer to have an audited financial statement. And some companies that may not be as equipped or able to perform complex computations often don't have audited financial statements, and they might not be able to avail themselves of some of these simplifying rules. It is very fact dependent on figuring out what rules and options are available to you. But one of the more interesting developments here is a brand new modified simplified production methodology. Rather than the old simplified production method, which is still available, there is a new modified simplified production method, and it actually takes and breaks things down a little bit more from a cost accounting standpoint. It's going to use two different formulas to capitalize the additional 263 Cap A costs to ending inventory. The first formula is focused on the pre-production costs and pre-production activities and capitalize those costs just to goods that are at that or have gone through that stage. The second formula addresses the actual production and post-production costs and activities and only capitalizes those costs to goods that would typically be associated with WIP or finished goods stage. Using this two-formula methodology can be beneficial to taxpayers that have a large portion of raw materials in ending inventory. Further, producers that have more than $50 million in gross receipts, if they're currently using the simplified production method and want to continue to treat negative adjustments as additional 263 Cap A costs, are now going to be required to use the modified simplified production methodology. So it might be required for some taxpayers in certain situations. It might be optional for others, but if you've got the right fact pattern, the modified simplified production method may significantly reduce the unit cap cost capitalized to ending inventory and thus reduce your taxable income. And really all taxpayers who are subject to Section 263 Cap A should review their current computations and methodologies in light of these final regulations. We've listed here some examples of situations where a taxpayer may be more significantly impacted. I mentioned the issue about audited financial statements. If you have the significant amount of average annual gross receipts, but also if you have few inventory turns or if you have different variances or burdens that have not been capitalized for book purposes, this really should be an area that you look at more fully. And how do we implement a tax accounting method change under these final regulations? Many taxpayers can do this easily with a Form 3115 in their 2019 or 2020 tax returns. But the analysis really needs to be based on a particular company's facts, the rules that they are subject to, the options that are available to them, and they need to do some computations and figure out what is the best approach for their situation. Okay, and with that, we're ready to go into the next topic about disaster losses. Now, this is a topic that not everyone may be aware of or have thought of yet. Typically, losses are generally deductible in the year that they're sustained for a particular transaction or an event. However, there is a special rule under Section 165I associated with federally declared disasters. And if a loss is attributable to a federally declared disaster, it does permit a taxpayer to elect to claim the loss 1 year earlier. So for example, a loss incurred in 2020 potentially could be deducted at the taxpayer's election in their 2019 tax return. Historically, this section of the law has been associated with physical damage to an asset, whether it be associated with damage to a building from a hurricane, inventory that might have been damaged or destroyed in a tornado. But with COVID 2019, we have the entire United States declared as under a national emergency, and that potentially might trigger eligibility for these disaster loss provisions in certain situations. Now, there are 4 requirements for a disaster loss. It must be a loss that's deductible under Section 165. It must be attributable to the federally declared disaster area. And what does that word attributable mean might become very important. The loss has to occur in a defined disaster area, which, as we saw, has been the entire country. And the loss cannot be compensated for by insurance. And I guess one thing I'll say besides insurance is maybe any other, compensated by any other type of compensation, like the Paycheck Protection Program or some of the other changes we've seen here this spring that Congress enacted to help small individuals and businesses to try and survive in this unique circumstance. But if you have not been compensated and you meet these other rules for a particular loss, you may possibly be able to make this election under 165I to claim the loss in a 2019 year tax return instead of 2020. Now, there's a lot of uncertainty. Go ahead.
Yeah, interestingly, one of the most challenging things to this analysis, aside from what we'll talk about in a minute with the attributable losses, is it has to be deductible under 165. So a lot of what our ordinary and necessary business deductions are deductible under 162. So something that otherwise would have been a utility cost, a rent cost, a payroll cost, those would have all previously been deducted under 162 and not 165. So a lot of the questions move around, okay, what is actually covered by 165 in the setting? And that's part of the reason for that is that this is largely, or has largely in the past been dealing with physical assets, where there was a very obvious damage to a physical asset, as opposed to trying to quantify or identify losses that occurred from your business being disrupted. How does that interact? How do the 162 and 165 loss rules interact in that situation?
Mm-hmm. That's a great point, Andrea. And we've listed out some areas where there are open questions about what could possibly qualify for this special treatment. But again, this would be a situation where you need to do an analysis on a loss by loss basis, look at your facts, try and match back up to each of those requirements and figure out, is this loss truly a 165 loss, not something that's deductible under 162? Is it truly attributable to COVID? What does that mean? There is a significant amount of uncertainty in this area, and the IRS is actively, again, working on guidance because they are generally concerned that taxpayers obviously do want to and need to understand how these rules apply to COVID, but they are concerned that taxpayers may be taking some aggressive or very aggressive positions in certain situations. And the IRS is trying to I think the word that I heard recently was madly working on guidance in this area. So we are expecting something. We'll, again, have to wait and see when that happens and exactly what it says and how it may apply to a particular situation. And with that, I think we're at polling question number 4.
Yes, which is, have you considered the impact of the disaster loss rules? Yes or no?
Poll is open.
Interestingly, people who live in areas that are more frequently impacted by natural disasters, wildfires, floods, hurricanes, tornadoes, may be more familiar with those rules than individuals who live in areas where those types of disasters are less frequent in occurrence. So it's been interesting to see there's a whole new side, there's a whole new group of taxpayers who are looking at these rules now that may have never even considered them before. And I think that's part of what's spurring the IRS to get some guidance out. And yeah, most people haven't really considered it, which is not terribly surprising, as I said, because there's so much uncertainty about how it could apply that people haven't been investing a lot of time and resources in figuring this out yet, but is something that is certainly worth considering as we get more guidance from the IRS on this. And our last topic today, briefly, we're going to touch on are the new leasing standards. So this is yet another new GAAP accounting standard that is going to have potentially a trickle-down effect on us on the tax side. These rules have been delayed, I believe. So now our non-public clients will be implementing them in 2020, I believe. But I think that is correct. And these technically did not change the tax rules. We still have the same rules on the tax side as we did before. However, the interaction between these two rules is an area where we see a lot of misunderstanding between our audit and our tax teams. And then how do we go about managing what the auditors are going to start doing? The tax criteria for distinguishing leases between what we think of as an operating lease and a capital lease is based on the benefits and burdens of ownership. In contrast, the financial reporting rules are based on length of lease, present value of payments, some more black and white tests. Our tests are all gray. We're looking at the economics of the transaction, trying to figure out who actually is getting the economic benefit from this underlying asset, because they should be treated as the owner of the asset for tax purposes. So generally, in order for it to truly be a tax lease, a lessor must retain the benefits and burdens or the economics of the asset during the term of the lease. And the lessee merely gets a right to use the asset. And why is this such a big deal? It's a big deal on the tax side because this significantly impacts when the income and loss from these transactions is recognized. At the end of the day, regardless of whether we classify this as a lease or a sale, we're going to get to the same overall net income number, but we're going to get there in very different paths under option 1 or option 2. And the main difference here is who's getting the depreciation. Because many assets now qualify for 100% bonus depreciation, whoever is treated as the owner of the asset is going to get that large deduction up front, so they're going to get to accelerate that tax benefit and then recognize the income more ratably over the term of the lease. Whereas if I don't have the depreciation, it's going to be a fairly consistent stream of income year over year. So we can get some very, very different tax answers depending on which party is deemed to be the owner of the property for tax purposes. So as I said, because the book rules are black and white, ours are gray, we can come to different conclusions in many circumstances. And we have situations where our tax is following book. So we're using the same classification as book is using, which may not be correct because we do have a different set of rules we need to apply. The good news is now the IRS has provided us with an automatic accounting method change to rectify that, to go back and say, I treated this as a sale, it should have been a lease, or vice versa, and making those adjustments through rental income, interest income, gain loss, depreciation, etc. Through a tax return. There was previously a change available, but it wasn't particularly helpful because it was strictly on a going forward basis. This new change allows us to make modifications to leases that are currently in place and adjust our taxable income accordingly. And one last leasing comment before we wrap up today. Section 467, as I referenced briefly earlier when we were talking about the revenue recognition rules, this is a special revenue and expense recognition set of rules for leases that have deferred or prepaid rents. So we have rental, if you have a rent holiday, if you have a balloon payment either at the beginning or the end, they will impact how that rental income and rental expense is reflected on the tax returns as well as the financial statements. Requires us also to recognize typically an interest component in connection with these. And this is going to become very interesting in application in light of COVID, because several of our commercial landlord type clients have been approached by their tenants and have asked for rent holidays. Well, if I give you a rent holiday that is effectively deferring my receipt of that rental income, 467 could kick in and force me to recognize some income during that deferral period. And I need to analyze all of my leases at origination and then upon a significant modification. And adding a deferral provision to an existing lease would be considered a modification, and I need to reanalyze all these lease agreements to make sure that I'm properly applying Section 467 in light of the modifications that are being made. So something to keep in the back of your mind as you're talking to your landlord property owner clients that are telling you, they're making changes on leases, they're doing things differently. We need to make sure we're understanding and reflecting those correctly for tax purposes. And then I think we got to the top of the hour, and did we end up with any questions, Amy? Nope.
I don't see any.
Okay. Well, this is our contact information. Thank you for joining us today. Feel free to reach out to either us if you have any follow-up questions on any of the items we discussed or any other accounting method related issues.
Have a great day, everyone. Thank you.
Thanks, guys. Have a great one. Thank you, Andrea. Thank you, Michelle.